Bloomberg Audio Studios. Podcasts, radio, news. Bloomberg Tech is live from coast to coast. With Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Amazon's cloud unit signs a $38 billion deal to supply OpenAI with computing power. Plus how Xiaomi's pivot from smartphones to electric vehicles may have come at a human cost. And all eyes on Palantir posting its earnings results after the closing bell. This is defense tech spending is ramping up. But first, we check in on the markets. Also ramping up. Not quite at a record high for the Nasdaq 100, but we are up some 0.4% for the big tech benchmark as we focus in once again on earnings and the never-ending desire for AI compute. Let's go there because the key points drivers on this particular benchmark are two stocks we shine a light on. Amazon pushing on 4.5% higher after significant gains on Friday after its earnings. This is a company that is, of course, shrinking its workforce, but focusing in on AWS growth. And it manages to sign OpenAI as that new client, $38 billion deal. We'll dig into it. Nvidia, well, they're the GPUs that go inside all these data centers. It too climbs in terms of market capitalization, up another 2.7%. I just want to go to the top story that is Amazon and OpenAI as they sign a $38 billion deal for further cloud compute. And it's Bloomberg's Seth Fiegelman that we turn to. Seth, in the grand scheme of things, it's not $300 billion of Oracle Cloud that we saw before, but it is notable that OpenAI turns to more and more cloud providers at this moment.
I think that's right. It really is telling about this moment for both companies. OpenAI just is tapping every possible resource it can to meet its cloud computing needs, and Amazon, which had previously been invested in Anthropic, is also trying to have a piece of OpenAI and possibly other players down the road. So it contributes to that incestuous web we keep talking about. Everyone is backing everyone else.
And of course, we'd seen a deal to offer OpenAI's open large language models into the overall Bedrock offering of AWS. But this is different. This is a 7-year deal. It goes out, but actually by end of 2026, we're going to see the amount of compute already necessary for OpenAI to go on to AWS.
A bit more near term than some other deals we've seen OpenAI broker, and OpenAI is leaving the door open to expanding with more investment down the road. I do think it's telling, though, that this is Amazon providing Nvidia chips, not Trainium, not in-house. So on the one hand, it's a testament to Amazon's ability to build up cloud computing infrastructure at scale to meet OpenAI's needs, but you have to wonder what that means about the quality of Amazon's own chips.
I mean, go into that for us, because they talk about the tens of thousands of Nvidia chips that are going to be used. But they then talk about the millions of potential CPUs that they might eventually help using. Is that where AWS's own vertical integration comes in?
It's possible, because I think the larger industry is also thinking more about investments in inference as opposed to training. So with training, you want those GPUs the best possible. But with inference, CPUs and some maybe second tier GPU type chips could meet the needs. So maybe that's where we see them play more.
And then take us to how AWS continues to therefore show this 20% growth that we saw on the Friday. Is it going to be more deals coming from OpenAI? How much farther can they sprawl? Or is it more about individual enterprises or sovereign AI, for example?
I think it's a little bit of all those. And I think what we're seeing with OpenAI in particular is that now that the exclusivity arrangement with Microsoft is kind of a done deal, they can tap everyone. They already have Google as a partner. They have Amazon. They have Nvidia, Broadcom, everyone. And I think Amazon's ready to play ball in that category.
Well, Seth Fiegelman playing ball with us this morning. We really appreciate it. Meanwhile, Nvidia, of course, as we just talked about it, the GPU supplier, it made history last week with the first company to ever hit a $5 trillion market cap. According to Loop Capital Markets, though, the company could add trillions more as Nvidia leads the, quote, golden wave of Gen AI adoption. Let's get out to Bloomberg's Ryan Vlastelica, because all paths lead back to Nvidia when we talk about any of these compute deals right now, Ryan.
Yeah, absolutely. It certainly feels that way. This is the latest in a series of street high price targets that we've seen on Nvidia. Before Loop, we had HSBC, which forecast, I think, 70 or 80% upside. And before that, we had an additional Loop street high price targets. People keep sort of outdoing each other, trying to estimate how high up this stock is going to go. So right now, the latest estimate points to about 8.5 trillion market capitalization. Like you said, it just hit 5 trillion. So that points to still a lot more potential upside from here. And the story hasn't really changed. People continue to see a lot lot of long-term demand for all kinds of AI-related hardware and infrastructure, and certainly it will expand out a little bit. Nvidia has a very important software business, for example, but in general, this is all about the GPUs that have been driving the AI trade really for the past couple of years now.
And look, their GPUs are also part of the Microsoft IREN deal that we're talking of today, a $9.7 billion look for compute of Microsoft using yet another neo cloud, this time an Australian one. We've also got in the news how Alphabet's selling a huge amount of debt to be able to finance the overall AI trade and compute purchase. But Ryan, you've got a great story in just showing how last week, if we reflect a bit, we started to be discerning about which companies were going to celebrate AI investment and ones that we're not going to.
Yeah, absolutely. So really the poster child on the other end of this trade is Meta. That stock fell quite sharply last week after it came out, really talked about its expense growth, its CapEx growth. It's talking about taking write-offs and all of this. I think there is more skepticism. People want to see that all of this spending is being done in a diligent and disciplined kind of way, and that this is really going to lead to some kind of pronounced return on all this investment. Now, I think there's still a lot of support for AI-related strategies overall, especially at companies like Amazon and Alphabet, which are showing a pretty direct link between all of this spending and improved performance in their cloud computing businesses. But for someone like Meta, which doesn't have an equivalent cloud type business, the story is getting a little bit trickier for them. People are getting a little bit more discerning. And like you said, we did see the stock come down last week, as I think people just are maybe getting a little bit of cold feet.
What's interesting, Ryan, is also you shine a light on how we've had a bit of dispersion outside of the key, Mag 7 and then some names, Broadcom and others thrown in. We've got some of the suppliers to the data centers or suppliers to some of these compute powers that are also winning. I mean, Micron's another key winner on the day, but you shine a light on other companies that have outperformed.
Yeah, certainly. I mean, it's not purely an Nvidia story anymore by any stretch of the imagination. Anything that is involved in any kind of components here, I mean, we've certainly seen Broadcom, another major winner, Micron, storage companies like Seagate and Western Digital. These have been some of the biggest performers of the year. They're a little bit less high profile, but they are certainly seeing very strong growth inflections because they are just part of the overall ecosystem that is required to build out all these data centers, power all the data centers, do storage, memory, all the stuff that is involved with AI and having it produce the the material that people are using. It's a much bigger trade than it was a couple of years ago for sure.
Ryan Vestelica, always with the must-reads. We thank you. Let's get more on this AI compute trend that's never ending. Tony Wang's with us, T. Rowe Price, Science and Technology Fund Portfolio Manager. Your top holding is Nvidia, and all paths lead back, but Microsoft's a big one, Broadcom, Alphabet, really all of the big winners. Is this playing out as you anticipated?
Yeah, well, I think that AI is a huge productivity driver, in my opinion, and I think that these companies are really well positioned to essentially capture that and be the platforms for, I think, growth in the economy. And what I'm looking for going forward is the new use cases really come through, like agentic AI, for example. I think it's to fill this capacity, it can't just be you and me using ChatGPT. It's got to be thousands of agents for each company, like making decisions and executing and unlocking. I think labor essentially is what I'm looking for, and that's what's exciting going forward.
It's exciting when you see Nvidia's name referenced in about 3 of the compute deals just on this Monday alone. But take us to perhaps the one that you don't own. Interestingly, you don't have exposure to Amazon and AWS, but it signs its deal with OpenAI. Has there been methodology around that, about its own cloud prowess, or perhaps worries about the lack of growth that we'd seen in previous quarters, bar from the previous numbers they just reported Friday?
Hey, well, I think that they had a nice earnings report, and I do think that there seems to be a lot more momentum now. You talk about the deal that they just did today, and just essentially like rolling out a lot more compute and accelerating AWS. I think is really good for the business. I think they're well positioned to essentially leverage AI in their e-commerce business, as well as be an infrastructure provider. So I don't think you can count them out at all, and it's good to see them outperforming. What's
interesting is someone who got beaten up is in the portfolio, which is Meta. And I'm interested in your take of how we're deciding who we reward of capital expenditure and who we don't. Yeah, well, I think that AI is a long-term investment for Meta, and I think that the market's probably digesting the
level of CapEx and the depreciation that's coming through the P&L. But I think that's a little bit too short term to view it. And you look past that, the returns are there, and these are going to be great investments. And Meta definitely has the digital formats to leverage AI, and they have tremendous scale across customers. And so I think it's exciting what they're doing in the SMB segment as well. If it unlocks a lot of ability for companies to essentially like reach customers with just a credit card and asking for the ROI from ad campaigns.
I just want to go to what President of Microsoft was telling our network a little bit earlier today about the risks of underinvesting really here. We spoke with Brad Smith. Just take a listen, Tony.
Our biggest challenge is not a risk of getting ahead of demand. It's actually keeping pace with demand. And what we are finding is that our customers, whether they be enterprises across the economy or governments or nonprofits, they are looking to us to build out this capacity. They want to use this compute. So for us, if we build it, it will be put to use. As it's put to use, there will be a return to our shareholders.
You, of course, have exposure to Microsoft, Tony. Brad really talking about how they're expanding more geographically as well and investing over in the Middle East, not just taking money from the Middle East. And I'm interested in what you think about Microsoft's need to depend on neoclouds. We saw them strike a deal with an Australian neocloud provider for Texas data centers. Is that something you like to see, that use of their money and capital expenditure on neocloud as well as their own?
Yeah, I think it allows them to be flexible and nimble. I think that standing up these data centers is no small feat. And a lot of times it requires various players. It requires the data center capacity, the power. And so I think it's encouraging to see Microsoft collaborate with the ecosystem and plug in partners. And so to me, I think it makes sense. I think it's also a testament to the demand signals they're seeing. And kind of the workloads really take off. And, I think AI is really hard to do. Not every company that is trying to do it is successful, but I think the ones that are finding success are, seeing tremendous promise. And so I think that's what essentially, gives people confidence to invest here.
Confidence to keep adding when we've seen runaway performance, not just of Nvidia at 5 trillion, but another one of your holdings, Micron, for example. I mean, significant outperformance. When do you decide that you want to cash in, profit take?
Yeah, we're all constantly managing position sizes in the portfolio, but in my opinion, I think that you want to be invested in the areas where there is essentially a bottleneck, that there's scarcity, and that performance depends on it. So I think that HBM memory, HDDs, and now NAND, there's becoming more of a shortage, and so to me, the industry is getting better, and it's a critical component. So from my perspective, there is opportunity for these companies to compound value over time.
You are, of course, equity focused, but when we have Alphabet selling debt in Europe and the US, any of that financing of this AI spend give you pause?
Yeah, well, I think it's novel, but you look at the cash generation of a lot of these companies; they're really blue chip, and to me, I think that this investment is smart, and to do the appropriate level of debt financing, I think, can make sense. In addition, I think that the infrastructure, there's a lot of debate of like the useful life of this. I know that Nvidia comes out with a new generation every year, but I think that these are longer-lived assets than people appreciate potentially, and they're not just like 3 years obsolescence, but probably more like 5 to 6. And so, in terms of the appetite to lend against it, I think that in 3 or 4 years, it's going to be more commonly accepted. And I think we're probably on the path there because these are really I think, revenue-generating assets, and there's a lot of productivity coming off of them.
And Tony, that productivity, as you started the conversation, is about how we deploy generative AI, and Palantir is one that really has. But how do they fight also the macro headwinds, the government shutdown? Do you have any concerns at the valuations that some of these companies trade at?
Hey, absolutely. I mean, these are, very elevated multiples, and so they need to keep delivering the growth here. Palantir is definitely, I think, at the tip of the spear in terms of implementing AI. I mean, they started doing that in the government, and now their commercial business is growing rapidly. And so, I think the government shutdown, I think that's probably a temporary thing. They could get a pass for that just because the government's not going to be shut down forever. And, you look forward, I think what really matters is that they're driving significant ROI for their customers, and they're able to do it in a way that connects their data. And I think that's the change in IT services is I think that you need to come with a solution and the engineers to help your customers instead of implementing a SaaS-based off-the-shelf solution. So I think that's what's exciting, and we'll see later on today.
Tony Wang, it's always great catching up with you. Another busy week with Palantir after the bell. We so appreciate your expertise. T. Rowe Price, thank you. Coming up, Xiaomi's pivot from smartphones to electric vehicles, well, it may have come at a very high human cost. More on that next. This is Bloomberg Tech. China's Xiaomi, it set a relentless pace to pivot from smartphones to EVs, but it may have come at a human cost. Bloomberg Spotlight story this week follows the intense schedule of Wang Peiji as he transformed Xiaomi's retail network before ultimately collapsing of a heart attack in 2024. Bloomberg's Peter Elstrom joins us now. It's a deeply reported story through the bravery of a widow who is convinced that it was his work schedule that in many ways contributed to his death at the age of 34, Peter.
That's right. So Wang was one of the key managers as Xiaomi, the company best known for its smartphones, decided that they were going to push into electric vehicles. The founder, Lei Jun, said this was going to be one of his last strategic plays for the company. He had really earned a fantastic reputation for himself in the smartphone arena, but he wanted to succeed in EVs too. Remember, this is something that Apple tried and wasn't able to pull off. Xiaomi has actually designed a very good car. They've been able to succeed in the market. They've been able to gain some traction in that space. But Wang was one of the key employees who was responsible for redesigning stores as they were shifting these stores from really showcases for smartphones to something that could show you a full-size automobile that would have the infrastructure to be able to show that off and demonstrate what kind of cars they actually had. So at one point he was responsible for 267 stores. He was working almost nonstop hours. His wife told our reporter that he would frequently work until the wee hours of the night. We also saw his WeChat messages where he was exchanging messages at 2:30 in the morning and working on and on and on. And as you mentioned, tragically, at the age of 34, he died of a heart attack. Yeah. And so it's a story really about how these extreme hours can take a toll on managers, especially in an area so competitive like technology.
Xiaomi has responded in part to our investigation and talking about their sympathies that go to the family. But set this in the context of 996, of what is very much a cultural focus on working extremely hard in China in tech.
Right, yeah, you're referring to 996. In China, they talk about working from 9 a.m. in the morning until 9 p.m. 6 days a week, which is extremely long hours. The World Health Organization defines overwork as working more than 55 hours. Now, in China, they work even harder than in the United States. It's about 49 hours on average for full-time workers compared with 45 in the United States. And in the tech industry, it's far beyond those kinds of hours. At Xiaomi, the workers, an independent survey showed that they were working 11 and a half hours a day. So you're talking about, almost 60 hours a week that they were working. And Wang seemed to be one of the workers who was going even beyond that at this point. So, of course, there's a lot at stake here. They're competing for leadership in AI, in chips, in electric vehicles, et cetera. And there's a lot of money at stake. When you look at the most valuable, the wealthiest people in the world, they're all tech entrepreneurs, led by Elon Musk, of course, but you've got Larry Ellison and Jeff Bezos in there, too. There's a lot of money at stake. There's also geopolitical advantage. And Xiaomi was pushing very hard to make this pivot into electric vehicles.
Peter Elstrom, thank you so much. It is an emotive story and a must-read. We appreciate it. Now, coming up, we'll dig into Apple, how it's set for a make-or-break year on the regulatory front as it gears up to start 2026 with a $140 billion quarter. This is Bloomberg Tech. Apple, well, it's set to kick off its 50th year with what's expected to be a nearly $140 billion quarter. For more, Bloomberg's consumer tech managing editor, Mark Gurman, has the details on this week's Power On newsletter, hotly read as always, Mark. And $140 billion is what the math reads out as of what their holiday quarter will look like. Important when April is their 50th anniversary.
Yeah, it's quite interesting. They normally, in the last half a decade or so, since the beginning of COVID, haven't really given guidance. But for this holiday quarter, they're back to that. So they said that the quarter would grow 10 to 12%. That's the current quarter, the holiday period. And that comes in anywhere between around 135 to 139 billion. Typically, when they've given guidance in the past, they've been conservative. So they like to sort of smash through that. And so you can imagine that internally, they're aiming for something north of 140 billion, which obviously would be quite impressive, given where they've been the last few years.
And therefore take us where they're going in the next year or so, because Power On really outlines the myriad of areas they're trying to leap forward on, not just Siri, but real hardware and chip updates too.
Yeah, there's a lot going on. You're going to see a series of M5 related updates to the Mac, things like the Mac Mini, the Mac Studio, the MacBook Air, and the MacBook Pro across the first 9 months or so of 2026. You'll see a foldable iPhone at the end of 2026. Perhaps the introduction of the smart glasses at the end of 2026. The first 3, 4, 5 months of 2026 are going to be chock full of things. A push into smart home devices, that HomePod with the display, the MacBook Pro and MacBook Air I mentioned, a ton of things on the software side related to Siri. So it's going to be a pretty jam-packed year for 2026. And then you go into 2027, where you're going to see even more major leaps and bounds when it comes to hardware.
And will it be the same people at the top? How do you see the talent and the focus and reworking of Apple continuing amid its 50th anniversary?
You know, Apple's biggest challenge right now is retaining talent, specifically for its AI division, its machine learning folks. They're bleeding talent to places like Meta, to Anthropic, to XAI. It's been very difficult for them to hold on to people because Siri, really, it has a really bad reputation. One of the big things they're going to be doing for Siri to improve it is using a custom model developed by Google's Gemini team. It's going to run on Apple servers, but Apple's paying Google to develop it. And that's a bit of a setback for Apple's internal models team. And so they've basically, for now, have split it, whereas the models that run on Apple devices themselves, the ones for Apple Intelligence, those are those in-house models, which have been somewhat problematic, depending on who you ask. And then for the Siri models, they're moving to Gemini to power some of it. So it's an interesting dynamic they've created there.
Mark Gurman, as always, it's a must-read. We so appreciate it. Let's check in on these markets because, well, we're close to record highs on the Nasdaq 100. We're just up by about 0.3% as the wall of worry when it comes to geopolitics is put to one side as we focus more on earnings to come after the Bell Palantir, of course, and more on what the AI trend is when it comes to compute. Let's focus in on that. The two key points contributors to the Nasdaq 100 are these two stocks. Amazon up 4.6%, a new record high. It's now worth $2.7 trillion. But that kind of pales into significance when you think of the $5 trillion that Nvidia is now worth. And that's because all roads lead back to Nvidia GPUs. This time, Amazon striking a deal with OpenAI to offer many GPUs in further data centers, a 7-year relationship with OpenAI now as they turn ever further into compute and data centers for various places. But look, it's not the only wall of news we have on compute. And Microsoft is another one that's planning to spend more than $7.9 billion on data centers, on cloud computing and employees, but all over in the United Arab Emirates. And it's over the next 4 years, capitalizing on a US government clearance to ship AI chips to the Gulf nation. Now, Microsoft Vice Chair Brad Smith explained why just during an interview with Bloomberg's Germano Besetti in Abu Dhabi earlier today.
If you look at the UAE now literally leads the world in the percentage of the population using AI, 59.4%, number one. Singapore, about a point behind, is number 2. Wow. But what we're seeing here in the UAE is across the economy, whether it's companies like ADNOC in the energy sector or the financial services or the healthcare sector, all of this is being put to work.
Discuss all of this with Bloomberg's Brody Ford, who covers Microsoft for us. And this was Brad trying to articulate, we expand in there. We've got the ability and the permission. Why do they want to be building out and expanding in the Middle East?
Because they need power, right? The Gulf is a very interesting market for data centers because in the US and Europe, in many ways, they're kind of tapped for power. Everyone is kind of scrounging for a megawatt here or there. In the Gulf, they have oil power and they are really keen to want to diversify their economies. And this seems like a pretty natural fit for data center companies. So we've seen Microsoft, we've seen Oracle want to expand their presence out there. And today is kind of the latest example of Microsoft coming out to say, look at all the money we're spending. This is a serious bet for us.
And capital expenditure that they did articulate in their earnings just last week. But Microsoft's been perhaps more upfront than many as to how they're having to use other offerings, neoclouds in particular. They've been leaning on Nscale and Nebius over in Europe. But here in the US, they're going ever more into Texas, but with an Australian company.
Correct. Yeah, we saw them ink about a $10 billion deal with an Australian company this morning. And it's funny because $10 billion sounds huge, but it's really like, 15% of what they've announced so far? I mean, the spending quantities here are really getting hard to fathom. Microsoft has committed around $60 billion to a variety of providers just to be able to rent these AI chips quicker.
And what's interesting is IREN is one of those sources of power and compute that all used to be in crypto. And another one of those that now suddenly finds itself the darling of an AI trade.
Exactly, yeah. CoreWeave is the classic example of this. Crypto market crashed and all of a sudden they said, hey, wait a second, AI data centers is the way forward. And Microsoft's been the most kind of prominent customer of these neoclouds, but we expect over time that every major hyperscaler looking for capacity is going to turn to these companies.
And when we think about the scale and the numbers, it can just become almost arbitrary. But I think the $3 trillion figure that Morgan Stanley's wrapped its head around is an important one, right? That 3 trillion of data centers are likely to be built out by 2028. But actually half of that's going to come from their own money. And then maybe the rest is coming from debt markets and the like. But Microsoft really does seem to be talking up how it's leaning on its own cash flows.
Correct, its own cash flows. But part of the neocloud stuff that's interesting is that they are leases, right? You are leasing. If you build a data center, you're stuck with it for a good 20 years, right? You lease for 5 years. If the demand environment changes at the end, you say, well, thank you, Nebius. It's been beautiful, right? So it gives them a lot more financial flexibility. And I think we should see that within the context of hyperscalers tapping unique financing sources, even like Google hitting the bond market today.
Oh, you lead us perfectly to our next segment. Brody Ford, we are as one. We so appreciate you as always. And meanwhile, he said it, Alphabet looking to raise about $15 billion from a dollar bond sale in the United States, according to sources. The deal is being offered in many as 8 parts, maturities ranging from 3 to 50 years. But the company's also tapping the European market, $7.5 billion of notes in Europe too. And this all adds to a wave of borrowing from tech companies. Remember, Meta's $30 billion one last week. And it's all about investing aggressively in AI. Now let's dig into the impact of all of this AI financing a little bit further. Anna Rathman's with us, founder and CEO of Grenadilla Advisory. You think this is smart, the way in which that they're tapping debt markets or depending on their own cash flow?
Good morning. I do think it's smart. I mean, sometimes cash on hand is the most powerful thing. And so it doesn't make sense to spend all of your cash and put it into, the future investment in AI. Sometimes it makes sense to borrow from the debt market and to finance it. And so that you have some leeway and some flexibility in what you want to do with the assets that you have.
And what about even more creative financing, such as these private credit deals and the way in which we see Blue Owl be Meta's partner of choice here? Is that what you're likely to see more of, not just ever more debt being tapped, but just off balance sheet?
Yeah, I think so. Private credit market is constantly looking for ways to deploy their capital that they're getting from the investors. And right now, the investment that seems the most exciting seems to be this data center and AI play. And if we heard from Microsoft and others last week during the earnings call, the demand is just out of this world, and they're having a hard time supplying that demand. And therefore, I think you're going to see more of it. And by the way, people are worried about this off-balance sheet financing. In my opinion, it's dangerous if you don't know about it, but everyone knows about it. So you can definitely put that into your calculation for, the valuations of these companies.
Okay, that's really interesting because in many ways, Meta has led the way in that creativity, and Meta got beaten up last week because of their capital expenditure, and perhaps it coming in a more rapid clip than the revenue growth that we're seeing? And how do you make the discernment that's currently happening among the AI players?
Yeah, with regards to Meta, I think there were a lot of things that were idiosyncratic. I mean, if we were to think about the cap stack, if debt is issued, equity investors don't like it, right? But if you look at the debt market, a lot of investors in the debt market actually liked it, and there was a lot of demand for it. But there was also the deal about Meta not being a hyperscaler, investors wondering where all of the investments are going, and they're going to invest more of it. So that's Meta. But everyone else, I think there is a race here, and there's a bit of a FOMO in all of the AI players, and there's a higher risk to missing out than to spend today and to see where we are tomorrow, because I think the demand is still going to be high tomorrow.
But is that FOMO leaching into the investment community, and is that a good way in which to invest one's money?
Right. So here are a few things. I think people thinking about valuations, and that's myself included, it's very, very high compared to historical norms. It's nerve-wracking, but it's a short-term, sentiment-driven play. Beta is subject to a lot of noise, and it's going to happen. There may be a correction, or people are going to get nervous. However, if you're a long-term investor, like a lot of our clients are, you're going to take a look at the fundamental value add of these, data center build-outs and AI moves. And I do think that there is something there. If you look at the S&P 500 index and the companies in there, how many can actually do the AI play? How many of them have the expertise, the vision, the balance sheet capacity to do all of this? And they're just a few. And that's one of the reasons why investors who want to put capital into the AI play have no choice but to go into it in the public markets, right? So I think the valuations, although they are high, they're telling us something about the future growth of these companies and AI in general.
And that can withstand what has been a torrid time of geopolitics, of angst, of trade. And Anna, I think it's interesting that you said it's noisy. It's been really noisy in other players, like rare earth stocks, for example, tumbling today because, well, maybe China will continue to export, and many had run up MP materials and other players thinking that we would be cut off more significantly from rare earth materials that were necessary for this whole AI trade. What do you make of some of the highs and the lows in ultimately a geopolitical war?
Yeah, if we think back to the Xi-Trump meeting from last week, in my mind, I think saying that it's a one-year truce is a little bit misleading, right? So it might not be fully 1 year. We might have a surprise even next month, who knows? And the truce part is also misleading because what I think is we just de-escalated. We just went back to where we were about 2 months ago. So it means that we're going to continue to negotiate, but behind the scenes, we're going to continue to push this forward in terms of actually racing each other. What happened after that meeting was that Mr. Trump came back to the United States, but Mr. Xi stayed and talked about having like an international body that governs AI. There is a lot of push here to having more power in AI and also in national security. This is just going to get more heated as we turn into 2026.
Wow, good place to leave it, and a good food for thought for the investor base. Anna Rathbun, we appreciate it, founder and CEO of Grenadilla Advisory. The final days in a closely watched campaign are here, and no, perhaps not the local elections you're thinking of. We're talking about, will shareholders vote to approve $8 trillion package for Elon Musk? Well, of course, that decision is about more than just money. Control of the company, shareholder value, corporate governance issues, they're all at play here. Let's speak with the University of Arkansas law professor Rob Anderson about all of this. You are a retail investor in Tesla, and you're very active within the X community of Teslarati or Tesla retail investors more broadly, Professor Anderson. But just lay it out for us as an active investor. Talk to us about the goals, the milestones, how you interpret them, as well as being a professor in corporate governance. Are they that hard to achieve for Elon Musk to get what could be up to $1 trillion in pay?
Yeah, well, thank you for having me on. I mean, there's been a lot of talk about how large the potential awards are here, but I think there hasn't been enough talk about how ambitious this plan actually is, requiring Elon Musk to grow this company to 8.5 trillion in market capitalization and 400 billion in EBITDA. So I think this is ultimately a question of what will this company be able to retain Elon Musk, who I think it's fair to say his value has been priced into the shares already quite significantly, and it's more than just, in my opinion, more than just a good idea to approve this pay package. It's actually essential for this company to transition to the next stage that's contemplated by the award.
You talk about the $8.5 trillion that they need to reach in terms of market cap, but there's also the milestones: 20 million cars, 10 million on FSD. You've got to see 1 million robots out there, an army that he calls them. But Professor, what's interesting is some have pointed out potential caveats here. They've talked about the board potentially being able to award him perhaps the first 3 tranches of the money promised, if perhaps the milestones were interfered with in some way. Maybe it's disasters, war, maybe it's interference by government, but also just other unspecified circumstances. So does that give you any pause from a corporate governance perspective?
Well, I mean, not really. I mean, it's normal for force majeure type considerations to be taken into account. I mean, somewhat ironically, when ISS recommended a vote against it, it took into account it specified that there was a lack of precision in some of the milestones, but also simultaneously said that the milestones didn't give the board enough discretion in the future to adjust it. So, I think it's a no-win situation in terms of writing a plan like this, because obviously unexpected events can occur that you can't fully anticipate in writing the plan. So I don't think those are particularly problematic. I mean, I think probably the most common criticism I've heard is that the first step of the milestone at $2 trillion market cap, people would have said it's too easy to achieve. But I think what that fails to appreciate is that the market has already priced in the fact that it believes this pay package will pass and that Elon will be retained for at least some period of time. So it's priced in his value already. And it's a situation where he's kind of cursed by his own success of, making the milestones easier to achieve because it's already priced in the value of his contribution. So, I sort of feel like some of the criticisms have been a bit unfair in that regard.
Well, some of the criticisms more broadly have been almost reminiscent of what happened in 2018, and the idea that basically corporate governance is lacking because a lot of people on the board are too close to him. How do you think that this pay package in 2025 answered that?
Yeah. So, I mean, the pay package now had the benefit, if you want to call it that, of a completely adjudicated Delaware opinion on that 2018 pay package. So they were able to address just about everything that the chancellor identified in that, including a totally different, having a special committee this time with totally different composition, addressing all the procedural aspects that the chancellor took issue with in the court opinion, as well as producing a extensive report that is more extensive than anything that I recall seeing in recent memory, to try to address all of those concerns, in addition to, of course, the shareholder vote.
You are, of course, a shareholder. Musk himself is a significant shareholder. He wants to be more of a significant one. He's got about 15% that he could put weight behind. He in Texas is allowed to vote for his own pay package in this respect. So many say, actually, this is just going to pass, but it's more an idea of the court of public opinion. They need to pass with such a majority to prove that this is borne out right. What do you make of that, Rob? Do you think that it will pass with flying colors in that respect and enough to stop the criticism continuing?
I think it will. Yeah, I think the shareholders other than Musk and Kimball will vote very substantially in favor of it. Frankly, the main criticisms I hear are certainly not coming from the retail shareholders, who overwhelmingly are not just supported, but I think are nervous that it won't pass by enough. And I think the value that Musk brings to this company, it's undeniable. If he left tomorrow, you can imagine what would happen to the stock price. And so I think it's unfair not to give him the benefit of the fact that the stock price has gone up by, looking at it now, at $130 since this pay package was even announced, right? So the market loves it. I don't see any criticism there. Really, it's just the sort of rigid voting restrictions of the proxy advisors that are going to be the obstacle here. It's the cookie cutter approach they have to apply because they have to try to treat Tesla like every other company when it's not similar to a hired CEO who's come in from the outside to manage a mature company. This is a founder-led company.
A nuanced approach from Professor Rob Anderson. We appreciate it, from the University of Arkansas. Thanks for joining us, and a retail investor in Tesla. Now coming up, Palantir shares, though, are up ahead of the company's earnings later today. We'll discuss what to expect next. This is Bloomberg Tech. Earnings season, it rolls on, and AI bulls, well, they're going to be watching Palantir closely. It reports after the bell. The stock's already up, as you can see, 170%, let's call it, on AI enthusiasm. Bloomberg's Lizette Chapman joins us now. And there are high expectations, 50% increase in revenue. Just talk us through what's going to fuel that growth, Lizette.
Right. So like you said, there is a lot of built-in anticipation, eagerness around this. We're going to they've beat the last 4 consecutive quarters. We're going to see if they're going to beat that again, or maybe they're going to fall short. What we're going to be looking for is whether they're able to translate these smaller customer deals, these $1 million deals, into ones that expand into, ones that really drive the U.S. commercial deals as well as international. That's on the commercial side. On the government side, we're going to be looking at how things are going here domestically as well as internationally with the boost that they've seen, that they've invested in the UK and a lot of NATO expansion efforts as well. So we're going to be looking to see whether they've been able to, continue to expand the sizes of those deals.
I mean, government spending for them in defense in particular has been such a tailwind, but we're also amid a government shutdown, is that any sort of headwind?
The people that we have spoken to indicate that is unlikely because of the lumpiness and long-term nature of these contracts. That doesn't seem to be a major factor that we have anticipated so far. What we will be looking at going forward, though, is again, will they be, and then where and how? And traditionally, international sales have been much softer than the U.S. ones. And, CEO Alex Karp has repeatedly said, it's U.S. commercial growth driving this. So we'll see if that continues to be the case or whether they've been able to boost their strength abroad.
I mean, really, analysts calling out the uncharacteristically large beats and raises that we've had prior quarters from Alex Karp and team. Is that what he needs to do to drive the narrative? Because, boy, is he good at driving narratives.
Yeah, I think that is a great question. And I think the markets are going to tell us, right? He has a famously very antagonistic relationship with Wall Street. He considers financial results a vulgar and inadequate way to judge a company success, and he's consistently married the financial results with what he considers as a philosophical mandate to create AI software for the use of the U.S. Defense Forces and allies. And so that's going to be what he's driving towards. So there is not just the focus on profit, but also there's some philosophical support that he may get or may not.
We'll get to that philosophy after the bell. Lizette Chapman, it's always great to have you on. Thank you so much. And that does it for this edition of Bloomberg Tech. Don't forget to check out our podcast. You can find it on the terminal, as well as online on Apple, Spotify, and iHeart. From New York, this is Bloomberg Tech.